So today we're doing a bit of a different one. We're going to be going through some examples of businesses where they have huge ownership, mainly from these third parties that basically create a huge overhang. I'm going to go through two real examples, one that's personally impacted me when I wasn't as cognizant of this, and then I'm going to go through another one where I've actually taken advantage of this and used this as a buying opportunity. And I'm going to be going through how the large ownership structure can vary, whether it can vary in the sense that it can be a huge negative, but it can also be a positive depending on the nuances. And that's what we're going to cover in today's video. So first one we're going to be going through is Corsair Gaming. So this company, just to give you a bit of backstory around the ownership here, they have this private equity firm called EagleTree Capital. They typically invest in these businesses when they are smaller, and then they basically help them grow and then typically sell them as they start to get into that mid-market type of range, which is around that $1 billion mark. And EagleTree Capital listed this company, Corsair Gaming, around 2020, if I'm not mistaken. In fact, we can just check. Yeah, around 2020. And the business at the time had an inside ownership of, EagleTree Capital owned about 67% of this business when listing it. So obviously that's a huge amount. That's 2/3 of the entire business they owned. And then also you have to be aware that this is a business which they've actively been selling, because we have to sort of know a bit more about EagleTree, and that's sort of the reason as to why I say it's important. You need to know the nuances here. So EagleTree Capital is actually a private equity firm. If you do a bit of research on them, you know that their typical holding period is about 5-10 years. As I mentioned earlier, they like to hold to that mid-market sort of range. So once it starts getting to about $1 billion, they'll sort of offload it. Hence, publicly listing, they must have thought this was the best way to get the most value for their book, essentially. And that's what they've done. They've publicly listed it, 67% ownership. And actually, if you'd been aware as an investor, you would have noticed that since that period, 5 years later, they have sold off about 15% of the company since. They're left with about 55%, I want to say 52%, something around that ballpark. And to be honest with you, if it hadn't sold off as much as it has the stock price, I reckon they would have sold off a lot more with you, a lot more than they currently have. And I think that sort of, whilst there have been sort of negatives associated with the business since, I think that's definitely the sustained selling pressure is definitely going to help the stock fall down. And so there's a couple of things going on here. So firstly, whilst the business was profitable when it got listed, so those of you who don't know, Corsair Gaming, sort of think of it as a more trendy version of Logitech. They basically do accessories, gaming parts, controllers, etc., keyboards, mice, etc., right? And you know, during COVID, when everyone was out there buying gaming PCs and whatnot, this business was obviously thriving, immensely profitable, huge growth rates. And yes, you could argue, you know, that wasn't going to be sustainable. Their profitability was going to drop, and it has, right? The business has become unprofitable. They're starting to get back to profitability now. They've had to take on a fair bit of debt and so forth. So stock has obviously fallen since. High expectations, well priced earlier, but you have to consider, well, why? Like, you've seen some other players who have partially been impacted, and you think, well, why have they haven't done as poorly as Corsair? Why has Corsair done the worst out of them? And if you think, well, you know, if you know that roughly, I'm just making these numbers up, but this, you can sort of do your own research here on this. But if you know that roughly like 10-20% of the selling pressure is coming from this huge shareholder that's just continuously selling for, you know, the last few years, then obviously that's going to have a huge amount of selling pressure that's going to build up over time, particularly if you're taking out 10-20% of the float every single day. And I mean, in fairness, EagleTree has been selling quite gradually here. To sell 12% over, you know, 5 years isn't actually that much for the size they own, in particularly, right? But it just sort of goes to show you that, like, it does sort of count to something. And Whilst it isn't as visible here because there are a lot of moving parts, I'm going to go through this next example, which has really sort of, to me, opened my eyes as to like how impactful this can be. And you know, I'm still a fundamental investor. I still look at the fundamentals of business. But if I know that, you know, if I know that this business, if particularly if I know that massive shareholder is actively selling, then I'm probably going to be a little less reluctant to jump in immediately and try and scoop something up. So for context, the next company is Ring Energy. This is one I've been eyeing for about a year or so before actually having get bought into the business. Started following it sort of start of January, I want to say. So it's been about a year and a half since I've sort of looked at this business. What initially intrigued me was at the time the business was trading about, I think it screened very well. So it traded about 3.5 times earnings. So very low price earnings multiple. But I just never really found it that attractive, considering that I knew oil prices were going down and that on a normalized basis of, when I say normalized, I mean future oil prices where they were going, it wasn't really, there was still some risk associated with it. The reward was good, but there are better opportunities for me. So I just kept an eye on this one. But what I didn't realize at the time was actually there was this huge seller of the stock, this business called, or this investment fund called Warburg Pincus. So Warburg Pincus, for those of you who don't know, are an energy investment fund. Again, they have about a 5-year time horizon, and they basically specialize in energy companies as sort of an energy investment fund would. And they've actively been selling. Well, you think, well, why have they been selling? And firstly, it's good to know that it's not a fundamental reason. For me as an investor, I'd be concerned if the number one shareholder was dumping the stock for a reason I didn't know. But no, it wasn't for anything fundamental. If you do a bit of research on their page and get to understand why, then you will actually know that, oh, actually they're transitioning into an ESG fund. Basically, the rest of their investments, which were in other oil companies as well, have gradually been exited over time. Ring Energy is no different, except Ring Energy is just a massive position. And what this has meant is that basically you had a business that owned 35% of the company. Yeah, that's right, a third of the company. Just let that sit in for a minute. And within the short span of about a year and a half, they dumped the entire thing, which is just ridiculous. That's got to be at least like 25% of the daily flow. It's just a ridiculous amount when you think about it. I mean, if you can see that it does about $3 million a day worth of volume over a year, that's $1 billion. They sold about what? Yeah, they still sold. It's still a ridiculous percentage of the flow. I think I may have exaggerated. That's probably like 10% of the flow, but still, immense amount just from one seller, right? And you can sort of see this with the filings they've made with the SEC, just sort of constantly showing that they're selling their position. But I mean, if you sort of look from like 2023 onwards is when this heavy selling pressure began. And sort of you can see that, like, we just look at the chart again. I'm not usually too big into charts because the past doesn't really dictate the future, but there is actually something going on here, which is what I like a lot more in this instance and sort of why I'm using it as a reference. So if you sort of look from 2023 onwards, you can see that, like, as oil prices started to fall, these oil stocks did fall. But what you would have noticed in particular is sort of from mid 2024, this company actually fell a further 40 at the bottom. Actually, it fell a further 50%. It fell actually 50-60% further. And actually, around mid 2024, you saw a lot of these oil and gas, particularly oil companies, sort of flatline, right? Oil prices suppressed, it stayed where they are, and actually they were already very cheap, so they just basically stayed flat. But the only one that consistently was going down day after day was actually Ring Energy. And around that period, it was actually particularly when Warburg Pincus was selling very aggressively to sort of finally offload and close their position, right? So you think, well, why are they selling? You know the reason, right? And you know that everyone else has stayed flat, and this company just continues to get cheaper and cheaper and cheaper and cheaper, right? And you can sort of, at the time, I've forgotten the numbers now, but at the time I sort of calculated how many they're selling on average per day based on sort of the last few months of selling, and you can sort of project that forward. And if you know that, they've only got about 8% of their stake left now, then or I knew at the time that, forgot exactly when, but they had about a month and a half left to finish closing off their position. A month and a half to 2.5 months left, right? So that's sort of when I was sort of thinking in my head, like, all right, this is going to be a great time to buy. I know it's going to sort of bottom around here, and even if it doesn't bottom, it's still a great place to buy, right? And actually, I released a video on it and sort of said why I'm not buying Ring Energy now. You will be able to see that on one of my videos and sort of say why I'm waiting. And basically, as I was sort of looking at it, one day I start sort of accumulating my position. I think it was around 7. So again, we go back from here. So mid-April 2024, about $2, which was still considered cheap back then. That's like when I started looking at the company and thinking, oh, this is quite cheap, right? So if it was cheap then, like how much cheaper has it gotten at 75 cents? So for it to fall from a $2, $1.90 to 75 cents, that's a huge drop. I think it was like 70 cents at the low, maybe 72 cents, right? I started acquiring my position, I think around 77, 75 cents, maybe 80 cents, I don't know anymore. But it was around that sort of ballpark where I thought that the selling was going to bottom out, basically. And that's sort of what happened, really. It sort of bottomed out around that position. Warburg Pincus actually, a month or two later, actually filed and basically said, look, we've completely sold out of our position, no more selling. And pretty much on the day or the following days, you can see around August time, it just shot up completely. I mean, it went up about 20%, 20, 30% over that short span of about a week, really. So really does show how quickly it turned around there, in terms of just by knowing that sort of fact. But that's something I'm cognizant of as an investor. If I see a massive shareholder, particularly if I'm not certain that they're around there for the long term, that they're there for like the next maybe 5 years, but they're there to sort of flip the position, particularly if they've done quite well in it already, or they have a reason to sell, such as an ESG fund, I would be very cautious of it because it's something I wouldn't want to get burnt on, like I had with Corsair Gaming. In this situation, I took advantage of it, and it's always a great sign to see a business trading so cheap, but there's a non-rational reason behind it. So that the reason for the sale was completely irrational, had nothing to do with the quality of the business, nothing to do with the future profits. It was more an ESG sort of goal that was set by the fund manager or the investing manager or the investors, right? So great opportunity to buy. That's something I've taken advantage of. But that's why generally now, whenever I look at buying a position, if I see a shareholder with more than 10, 15%, I need to really understand, who are they? What are they doing? What's their plans with it? And you can get the likes of BlackRock, Vanguard, and pretty much any company you invest in nowadays. And they're always going to be like the top 1, 2, 3% shareholders in the business usually. And to me, that's all right because they're passive funds. There shouldn't really be a reason that they're selling out because they're usually buying through sort of the likes of their index products. So it would be very unlikely for them to just mass dump the position. Let's say if they had a position in Ring, right? But if I know a private equity firm has bought in a few years ago, they've done quite well on their position, and or even if they haven't done quite well, but it's been a few years now, that they're probably looking to exit at some point, and that to me can cause a massive selling pressure, right? So now, does that mean if I find like the amazing opportunity and there's a 20% shareholder and I think they might sell over the next few years, will I sell? No, not really. Will it prevent me from buying? Absolutely not. But it is just something to take into account, particularly as those percentages get up. We're talking like 35%, like with Warburg Pincus, you can really sway the company. Never mind sort of the likes of EagleTree. I mean, damn, if I knew that at the start, I would have completely changed my outlook. And that's something to be aware of, and it's something I've learned over time as well. Hope you found that useful. I'd be interested to see if there are any other opportunities like this. It's quite hard to sort of screen for it either. You can't really screen for like massive shareholders selling. It's not really something I could do. But yeah, it's always interesting when you can sort of see these opportunities that pop up for not rational reasons, and they're typically the best ones because you can be relatively confident buying into it. Hope that was useful. Thank you.